Something absolutely bizarre is happening in the precious metals market right now, and if you're holding silver or thinking about buying it, you need to understand what's unfolding because this situation is unlike anything we've seen in modern commodity trading. The silver market just did something that shouldn't be possible according to every economic textbook ever written. It broke. Not broke as in the price crashed. Broke as in the actual mechanism that allows silver to trade hands between buyers and sellers has stopped functioning. Let me paint you a picture of what's happening on the ground right now. Walk into any precious metals dealer, whether it's a local coin shop on Main Street or one of the big online retailers, and you'll see the same thing. Empty shelves, sold out signs, website inventory counters reading 0, silver eagles, sold out, silver maples, sold out, generic rounds, sold out, 100-ounce bars, sold out. Everything is gone. The display cases that used to gleam with rows of shiny coins now sit empty with nothing but velvet trays and dust. Now, in normal circumstances, when a product is sold out and demand is through the roof, what happens? Basic economics tells us that prices rise until supply and demand reach equilibrium. Sellers become eager to acquire more inventory because they can sell it at premium prices. If you walked into that same dealer with a truck full of silver, they should be fighting over who gets to buy it from you. They should be offering you premium prices, competing with each other, begging you to sell to them because they have a line of customers waiting to buy. But here's where it gets weird. Here's where the market broke. When you call these dealers and say, hey, I want to sell my silver, an increasing number of them are saying something that makes no economic sense whatsoever. They're saying no bid, not a low bid, not we'll give you spot minus $10, just flat out, we're not buying. We don't want your silver. We cannot make you an offer. This is the paradox that shouldn't exist. Sold out everywhere, but nobody wants to buy. Demand at record levels, but dealers refusing to purchase inventory. The price at all-time highs, but the market mechanism frozen. So what's actually going on here? How can this be happening? To understand this crisis, you need to understand how the precious metals distribution system actually works, because it's not as simple as you might think. Most people imagine that a coin dealer operates like a pawn shop. They have some cash in the safe, they buy stuff from people who walk in, they mark it up a bit, and they sell it to other people. Simple retail business. But the modern bullion industry doesn't work that way at all. It's far more complex, far more financialized, and as we're now discovering, far more fragile than anyone realized. The precious metals market operates through a tiered distribution system. At the top, you have the refineries and the mints. These are the entities that turn raw silver into bars and coins. Below them, you have the wholesalers. These are massive companies with enormous credit facilities that buy millions of ounces from the refineries and hold inventory in warehouses. Below the wholesalers, you have the retail dealers, both online and brick-and-mortar shops. These dealers buy from the wholesalers and sell to the public. And at the bottom, you have the individual buyers and sellers, people like you and me. In a healthy market, silver flows down this chain smoothly. The mint produces coins, wholesalers buy them in bulk. Dealers order from wholesalers, and customers buy from dealers. When someone wants to sell, the process reverses. The dealer buys from the customer, sells back to the wholesaler, and the metal flows back up the chain to be recycled or held as inventory. But right now, this flow has stopped. The chain is broken. And it's broken at the most critical link, the wholesaler level. Reports are coming in from across the industry that major wholesalers, the giant companies that serve as the arteries of this market, have gone no bid on certain products. They're not buying. When a retail dealer calls to sell back inventory, they're being told, we're not making a market right now. We cannot give you a price. This is catastrophic because the whole system depends on the wholesaler being the buyer of last resort. The retail dealer doesn't have the capital to hold massive amounts of inventory. They need to flip it quickly. They rely on the wholesaler to provide liquidity, to always be there to buy when they need to raise cash. But that liquidity has vanished. Why? Why would a wholesaler refuse to buy silver when silver just broke its all-time high and demand is exploding? The answer isn't what most people think. It's not because they don't want the silver. It's not because they think the price is going to crash. It's because they're out of money. They're broke. I know that sounds insane. How can a silver dealer be broke when silver is at record prices? Shouldn't they be making fortunes right now? To understand this paradox, you need to understand how these wholesalers actually operate financially, and this is where it gets technical, but stay with me because this is the key to everything. Precious metals wholesalers don't operate on their own cash. They can't. The amount of capital required to hold tens of millions of dollars worth of inventory is simply too large. Instead, they operate on credit. They have revolving credit lines from major banks, often worth hundreds of millions of dollars. This allows them to buy huge quantities of metal, stock their warehouses, and serve the market. But banks don't give out hundreds of millions of dollars without protection. They require the wholesaler to hedge their position. What does that mean? It means that for every ounce of physical silver the wholesaler buys and puts on their shelf, they must simultaneously sell an ounce of paper silver on the futures market. This is called a short hedge. On paper, this looks like perfect risk management. Let's say the wholesaler buys 1 million ounces of silver at $50 per ounce. That's $50 million of inventory. But silver is volatile. What if the price drops to $40 before they can sell it? They'd lose $10 million, which would wipe out their entire profit margin for the year. So to protect against this, they short 1 million ounces of silver futures at $50. Now, if the price drops to 40, yes, their physical inventory loses 10 million in value, but their short position on the futures market makes 10 million. The two cancel out. They're hedged. They're safe from price volatility. They can focus on their real business, which is moving volume and capturing the spread, not speculating on price direction. This hedge works beautifully in stable markets. When silver trades in a predictable range, when it moves a few dollars up or down over the course of months, the hedge does exactly what it's supposed to do. It protects the wholesaler from losses and allows them to operate safely. But here's the fatal flaw. This hedge only works in normal markets. It was designed for stability. It was never designed for what's happening right now. Silver isn't moving a few dollars over months. It's moving $20, $30, $40 in a matter of weeks. It went from $25 to $95 in an accelerating parabolic curve. And when that happens, the hedge becomes a death trap. Think about what happens to that short position when silver explodes higher. The wholesaler bought physical silver at, let's say, $30 and shorted paper silver at $30. Now silver is at $95. Their physical inventory has gained $65 per ounce. That's fantastic, right? They're sitting on massive unrealized gains. But here's the problem. Their short position on the futures market has lost $65 per ounce. And unlike the physical inventory where the gain is just a number on a balance sheet, the loss on the futures is realized every single day. The exchange calculates how much money the short position lost and demands cash immediately. This is called a margin call. Variation margin must be met by the next business day or the position gets liquidated. Let's do the math on this. A mid-sized wholesaler might have 10 million ounces of physical inventory. If they're properly hedged according to industry standards, they're short 10 million ounces on the futures exchange. Silver has risen roughly $70 from the lows. That means their short position has lost $700 million. $700 million. The exchange wants that money now, not next month, not when they sell the physical inventory. Now. Where does a wholesaler come up with $700 million in cash? They don't have it sitting in a checking account. They're a volume business operating on thin margins. That kind of cash doesn't exist in their operational budget. So what do? They drain every available source of liquidity. They empty their bank accounts. They max out their credit lines. They stop paying for everything that isn't absolutely critical. And critically, they stop buying new inventory because every dollar they have is going to the exchange to maintain a hedge that's supposed to protect them, but is instead bankrupting them. This is why they're no bid. It's not a choice. It's not a strategy. They literally cannot write checks to buy silver because all their money is being sucked out by margin calls. The computer system won't let them exceed their credit limit. They're paralyzed. Now you might be thinking, okay, but this is temporary, right? Eventually they can close the hedge, sell the physical silver at the high price, and they'll be fine because the gain on the physical offsets the loss on the paper. In theory, yes. But here's the second crisis hitting simultaneously. The banks that provided those credit lines are pulling back. They're reducing limits. They're tightening terms. Some are calling loans. Why would they do this at the worst possible time? Because from the bank's perspective, this whole situation looks like a disaster waiting to happen. They see unprecedented volatility. They see their borrowers struggling with massive margin calls. Their risk management algorithms are screaming to reduce exposure. So they do exactly that. They cut credit. This creates a doom loop. The wholesaler needs more credit to survive the margin calls. The bank reduces credit because the situation looks risky. The wholesaler has even less capacity to operate. The bank sees worsening financials and cuts credit further. Around and around it goes until the wholesaler simply cannot function anymore. They go from making markets to survival mode. They hoard whatever cash they can, scrape together just to keep the doors open. And that's how you get to sold out but no bid. The infrastructure has failed. The mechanism that allows silver to flow through the economy has broken down. Now let's talk about what this means for the little guy, for the local coin shop owner who's been serving his community for 20 years. These small businesses are about to get wiped out. They don't have the massive credit lines that the big wholesalers have. They operate on even thinner margins. Their entire business model depends on rapid inventory turnover. They buy silver from customers in the morning, sell it to the wholesaler in the afternoon, use that cash to buy more silver the next day. It's a cash flow business. But when the wholesaler stops buying, that entire model collapses instantly. The local dealer buys silver from a customer, then calls the wholesaler to sell it and gets told we're not buying today. Now the dealer is stuck. Their cash is tied up in inventory. They can't move. They can't buy more silver from the next customer who walks in because they don't have the money. Within days or weeks, they're insolvent. We're about to see a wave of closures that will permanently reshape this industry. The consolidation that follows will be brutal. The biggest players, the ones with the deepest relationships with banks and government, will survive. They'll absorb the market share of hundreds of failed small businesses. When the dust settles, we'll be left with maybe 3 or 4 giant corporations controlling the entire retail precious metals market in America. Competition will be dead. Premiums will be whatever these oligopolies decide to charge. The spread between buying and selling prices will widen to levels that would have been considered outrageous before but will be accepted as normal because there are no alternatives. This is how every crisis ends. The big get bigger, the small disappear, and the customer pays more. But here's the fascinating part. You can destroy the institutional infrastructure, you can bankrupt the dealers and freeze the credit lines, but you cannot destroy demand. You cannot make people stop wanting silver. And you definitely cannot make the physical metal disappear. When official channels close, unofficial channels open. This is where peer-to-peer markets emerge. When the coin shop closes, when the wholesaler goes dark, people who need to buy and sell silver will find each other directly. They'll trade privately, negotiate prices face-to-face, conduct transactions outside the entire system that just failed them. This is already happening. Online forums are lighting up with private sale offers. Local meetup groups are forming. People are connecting through networks that don't require banks or dealers or exchanges. And here's what's remarkable about these peer-to-peer transactions. The price is completely different from what you see on financial websites. In private deals, silver is reportedly changing hands at significant premiums to the official spot price. We're hearing reports of transactions happening $30, $40, even $50 above spot. Why? Because the spot price represents a paper market increasingly disconnected from physical reality. When you're standing in someone's garage looking at actual silver bars, and both of you know that acquiring metal through normal channels is nearly impossible, the price becomes whatever it needs to be for the transaction to happen. Pure supply and demand with no intermediaries taking a cut. This bifurcation between paper price and physical price is going to widen dramatically. We could easily enter a scenario where the screen shows $100, but actual metal trades hands at $150 or more. That gap is the trust premium. It's what you pay to hold something real instead of a claim check that might not be honored. It's the price of opting out of a system that just demonstrated its inability to function under stress. As more people recognize this gap, as more transactions happen at the physical premium price, that becomes the new reality. The spot price becomes a reference point for paper settlements, while real metal trades in its own universe. So what does this mean if you're holding silver right now? You're in a paradoxical position. On one hand, you own an asset that's clearly scarce, clearly in demand, clearly revaluing higher. The fundamentals have never been stronger. Industrial demand from solar panels, electronics, and electric vehicles is at record levels. Investment demand has gone parabolic as people lose faith in currency systems. The supply situation is dire with mining production flat and recycling flows collapsing. Everything points to much higher prices ahead. But on the other hand, the liquidity you thought you had access to has evaporated. If you assumed you could walk into any dealer and sell your stack for close to spot price, that assumption just died. The system cannot handle the volume. Many dealers either can't or won't make you an offer. For some people, this feels like a trap. They wanted liquidity and discover they don't have it, at least not through traditional channels. But for others, this is exactly what they prepared for. They understood that in a real crisis, official systems close and alternatives emerge. They're ready to transact peer-to-peer. They have networks and relationships. They don't need institutions to facilitate trades. This moment separates speculators from insurance buyers. Speculators panic because they can't easily flip positions. Insurance buyers understand that insurance isn't meant to be liquid in the conventional sense. It's meant to preserve value across catastrophic events. And a catastrophic event in the precious metals distribution system is exactly what's unfolding. The silver market breaking isn't the end of silver, it's the end of the old system for trading silver. What comes next will be messier, less convenient, more localized, and probably more expensive for those trying to acquire metal. But for those who already hold it, who custody it personally, who don't rely on institutions for access, this breakdown actually validates their entire thesis. They bet that the system was fragile and would fail under pressure. They were right.